So this year so far, the stock market is down almost 15%. Not to mention that the cryptocurrency market is also down 40% so far. And this I checked this morning around the 3rd of June. So it may even get worse than that going forward. So in today's video, I want to talk about how you can go about managing your emotions when the market isn't doing so well. We all know that investing has a lot to do with strategy, it has a lot to do with your planning, but it also has a lot to do with your emotions, because no matter how great your plan is, we are still emotional beings. That means that your plan might actually be good, it might actually be the right plan for you, but if you are in a state where you are scared of losing your money in the stock market because you're just seeing things going down, you might end up making a wrong decision just based on the short term. So in today's video, I want to talk about how you can manage your emotions as we go through this phase in the market, because it is really a phase. This is not the first time that the stock market is taking a downturn. This is not the first bear market that the market will go through. In fact, there's been 28 bear markets since I think 1928. So this is not new, it will come, it will pass. So in today's video, I want to talk about the emotions, how to manage those emotions, and also, of course, talk about why we are actually in a downturn. If this is your first time here, my name is Thando. I love talking about money, financial independence, building wealth, and just living a more fulfilling life. If that sounds like something that is up your alley, be sure to hit the subscribe button. I have videos for you every single Wednesday. Hit the like button and join the community. We talk all about money here on YouTube, over on Twitter, as well as on Instagram. So one of the first things that is really important to think about when you are in this current environment within the market is, why do downturns happen in the market? So that you know exactly why this is currently happening, and you can have a more informed understanding and approach to it in terms of making decisions going forward. So there's a lot of reasons why market downturns happen. There's a lot of reasons why we go into bear markets. These include, firstly, geopolitical reasons. For example, if there's a war, that would definitely impact the market. And also there's rising inflation. As we know, there's rising inflation in America currently, which means more people are not willing to spend their money because they're scared that there might be a recession coming. So that all affects the stock market. And one of the things that I've actually been thinking about personally is how the stock market, or like the index funds especially, are composed of like really high growth tech companies. So when you're buying a growth stock, you're essentially buying into the hope that that stock might not be valued at its true value at that point. So you're betting on what you think is going to be the future value of that growth stock, and that is basically some of the top companies in the world in index funds that actually are growth stocks, and those have taken a really big hit, especially within the tech industry. So that is also part of why we're seeing such a big downturn within the stock market. But of course, all that I ever share here on social media, on YouTube, it is not anything you can take and say this is exactly what it is. This is just for educational purposes. So if you have ideas of why all of this is happening right now, you can leave a comment down below. Always happy to hear from you guys. So the next thing, which is really the main reason why I'm making this video, is to talk about how you should be managing your emotions going into or within this current phase of the stock market when we are seeing red. So if you've been watching this channel for a while, or you follow me on social media, then you know that I'm a very big advocate for long-term investing in exchange rate funds, investing in index funds. So that's like the first group of people I want to talk about, because I think that is most of my audience. So first of all, if you're a long-term investor right now and you're not planning to retire this year or next year, then this market downturn really is just a sale. And I say this with the assumption that you're investing in broad-based ETFs and broad-based based index funds that give you a lot of diversification without you having to pay a lot of money for it. And the idea here is your strategy really at the core of it is just betting on the market. So you're buying whatever the market will return. So if the market at the end of this year turns out like 10%, or it turns out we actually lose money and it ends at -2%, then that is what you get. You're betting on whatever the market returns. And that is, broadly speaking, a really good strategy. And it's been proven to work quite much better as compared to picking individual stocks. There's literally people with Ivy League degrees, people who do this for a living, people who've done this forever, but they cannot consistently predict what happens in the market. So if you are one of those people who's investing in an ETF, investing in an index fund, just every single month, whatever amount that you have, and you're taking that dollar cost averaging approach or rand cost averaging approach, then you are pretty much good. And I'm saying this with a little hesitation because, of course, everything that I say in this video or anywhere else is not financial advice. It's just education and just me talking on the internet. But that is a really good strategy. It has been proven to work really well in the long term. So if you're a long-term investor, you don't really need to be nervous, but that doesn't mean that you won't be nervous. So if you are feeling nervous, you feel you're on edge, it's really helpful to review your financial plan, your strategy, so that you can remind yourself why you made the decisions that you made and why you invested in the things that you invested in. This will kind of reinforce you in that decision so that you don't feel the need to change your strategy or change your plan just because things are not going well right now. As long as you have that big picture view, it makes it much easier for you to actually hold out in the short term. And like I said, the market always goes through cycles. Just because the market is a downturn now doesn't mean that it's always going to be in a downturn. If you look at the market the past 10-20 years, it doesn't go like this, it goes up and down like that. So that's essentially what you kind of have to remember and remind yourself constantly. But if you are a long-term investor with a different strategy, let's say maybe you are investing in individual stocks only, or maybe you're investing in individual stocks and ETFs and other things, maybe bonds and crypto and things like that, then you might want to really look into your plan and make sure that you're still happy with that plan going forward. Because in the example that I just highlighted, you're not just a passive long-term investor, you're more of like an active / long-term investor, in the sense that you have active investments and passive long-term investments such as ETFs. So you might want to sit down, look at your strategy, make sure you're happy with that strategy, make sure you're happy with that plan going forward, and that will help you to make sure you're making the best decisions for yourself right now without making decisions just based on like panic or just your nerves, right? So, but generally speaking, the golden rule is to always keep buying. You have to keep buying. You have to actually ride out the storms, the downturns, because that's really where people really build wealth. Because essentially you're buying these investments at a discount, right? So at the end of the day, once the market eventually recovers, you will be able to actually recoup any quote-unquote losses that you get. And I say quote-unquote because all those losses that you guys are seeing in the stock market right now or in your portfolio are not really losses. They're just losses on paper. They will only become real if you decide to actually cash in and sell those investments right now. So essentially you'd be selling them at a loss, and that's when your losses actually actualize, right? So for now, it's literally just numbers on the screen. It really doesn't mean much until you decide to actually cash out, because then you're deciding that, okay, I'm not going to give these investments a chance to maybe recover in the future. So one of the things that I really like about being a passive long-term investor is I don't necessarily have to worry about all the other things that active investors need to worry about. Because if you're an active investor currently, then you have individual stocks that you've been investing in, and you're not necessarily investing in broad-based index funds or exchange traded funds. So essentially betting on those individual companies. So the tricky thing here is, because you are betting on those individual companies, the idea is that if you are going to make all your money back or make profit from that investment, then that company needs to actually survive this downturn and even thrive after it, right? And it's very, very tricky to actually be able to pick which company is going to be the most successful company. Like I said previously in this video, it's very hard to predict the market or to predict which companies will be the winners of the day, right? Which is why index fund investing and investing in ETFs is so popular, because it removes that need to decide or to try and predict what the market is going to do, and instead just basically investing in the entire market. With that being said, that doesn't mean that just because you're an active investor, now you need to be super stressed out and your strategy is just going to burn. No, it literally does not mean that. It just means that you have to do a little bit more work in assessing your plan, in assessing your strategy, in assessing the companies that you're invested in, to make sure that those are still the right investments for you. So there's a little more work that goes into it, because of course with active investing you take on more risk, which means you need to do a lot more work to make sure that you're making the very best decision for yourself as possible. And it's really helpful to actually talk to a financial planner or a financial advisor if you decide that you might want to make a big change within that portfolio. It might really help. But in terms of managing your emotions, going back to your plan, knowing that you have that plan and understanding it and being happy with it is what's really going to help you to regulate your emotions really, really well. And the trick, guys, because I know we're humans, we struggle with like just regulating our emotions. Even when we know we shouldn't be nervous, we can still be nervous, right? And a good practice is, if you feel like every time you open your Enquiries account, your Robinhood account, or whatever account that you use, that you're getting like nervous and stressed and getting anxiety from that, just don't look at it. You don't have to look at your investments every day or every month, really. If you are like me, for example, and you're investing for the long term and you have like 10, 20, 30 years to go of investing, then just don't look at your investments. You don't have to look at them all the time. It's okay. You can like revisit them after a few months, or when you feel like we are in a better like state, or when the market recovers, if you like. But essentially the moral of the story here is to not let your emotions push you to make big financial decisions or big changes within your investments be just based on what is happening in the short term. Look at the bigger picture. Just remember how much time you have to invest. Remember the amount of risk that you're willing to take. And speaking of risk, I almost forgot actually to mention this point, and it's a really important one, is this is actually a good time to fill out whether or not you were in the right risk category, because we know there's different levels of risk, right? There's low risk, medium risk, high risk, or very high risk as well. So you want to think about, okay, do I feel comfortable with the amount of risk that I've taken within my investments right now, since the market is not doing so well? It's a great time just to fill it out, especially if you're just starting out with your investing journey, right? So that's just another thing to think about, another thing to consider. And also just avoid listening to like doomsday media. Like, I'm pretty sure media like predicts that the stock market is just going to crash and everything is just going, or just this whole world is just going to blow up every other year. So like, don't listen to doomsday media. If that triggers you, avoid it. You know, you don't need that negativity. It's okay, you know. Anyway, guys, I hope that this video helps you. Please leave a yellow heart emoji in the comments if you've watched until the end of the video, because I really appreciate it. It makes me so happy when I see those hearts. Anyway, guys, thanks so much for watching, and I'll see you in my next video. Bye.